Okay, good evening. Welcome again to Global Associates video lecture series. Today I'm planning to discuss one topic from SBR, ACCA SBR. The topic is about ethical duty of accountant. On that, let me pick this example that is from the BPP, where we will discuss the aspects and the requirements of this. Let me go through the question. Ketchel is a public limited company. It's a public limited company. When they say public limited company, we have to relate the situation and think that there could be, board of directors, and there could be corporate governance, and there will be executive directors, non-executive directors, and so on. These are possible assumptions. We just have to think on that way. The current year is 31st December 2005. 2005 or 2015, or that is the current year. And now that means this is the financial year of the company. The finance director remuneration. Finance director is remunerated with a profit related bonus and the share appreciation rights. Now, the director finance salary is or remuneration is related to the profit related bonus. The profit is, the short term, and accordingly, the bonus will be computed for the finance director, and also there has been a share appreciation right. The question itself is saying that share appreciation rights mean that the director will become entitled to future cash payment based on the increase in the entity's share price from a specified level or over a specified period of time. That is the situation. So the director will be remunerated on this basis. Now, whether is this a good practice or bad practice is a different argument, but currently that is the policy of the company. Then Ketchel owns a significant number of owner-occupied properties, which historically have been held under the revaluation model. Now here, you have to relate this to the IAS 16 revaluation. IAS 16 revaluation, where whenever you do a revaluation, the revaluation surplus, if there is a revaluation surplus, that revaluation surplus should be treated how as under other comprehensive income and statement of changes in equity when you have any surplus. Due to economic downturn, property prices have been falling. But now what is the situation? The situation is such that the property prices are falling. When the property prices are falling, and if you are still adopting revaluation surplus method, what can happen is that the as a result of the revaluation, you are possibly will arrive deficit. There could be deficit. Possibly there may be deficit on due to the revaluation surplus. And the finance director is proposing to switch from the revaluation model to the cost model. Now here we need to pay attention. Now what is the attention that we need to pay here is that when you are planning to shift from one model, revaluation model, to a cost model, that is something to do with the accounting policy. Now, accounting policy, if you're really planning to change, then we need to think about IAS 8. IAS 8 is talking about changes in accounting policies, accounting estimates, and correction of errors. So, whether is this changing from revaluation model to cost model, are we complying with the IAS 8? Shortly before the year end, now they are bringing another story here. Shortly before the year end, the CEO of company who holds large number of share options, what happens is that they mentioned that he mentioned to the finance director that he was hoping to retire within the next year and hoping to maximize share price by his retirement date so that he will have maximum cash due to selling of shares. Right. This is the background of the situation. Now, requirements. Discuss the view that the board of directors should be remunerated with profit-related pay and share-based payment to align with directors and stakeholders' interest. Now, here what we then have to think about that, when the director's remuneration, how should this be based? If the director's remuneration is based on performance related pay, and if that is based on a long term objective, what could happen is that the directors will be interested to generate more profits. If the directors are interested to generate more profits, then that will be better to the shareholders of the company. So generally, that is the best method where you define the remuneration of the directors based on the performance of the company. However, when this is the situation, but with the current arrangement here is that now the directors are planning to change the accounting policy in order to maximize its return. What he's thinking is that when revaluation surplus method or revaluation method, when the property prices are falling, then the company will end up having deficits. So if you to charge these deficits to profit and loss account, then the bottom line that the profit for the year will be less. Then as a result, the end of the day, final return for the company will be less. Therefore, the bonuses and other performance-related pay will be less for the director. This was the thinking of the directors when he is planning to change from revaluation method to cost method. Here, following points need to note. The one of the point is that is it now what is the accounting standard says? Now, if you think about IAS 1, IAS 1 is the presentation of financial statement that says that when you produce all financial statement that must be complied with applicable accounting standards. All the financials, when the financial statements are produced, that should be produced with the applicable, it should be complied with applicable accounting standards and the IASB's conceptual framework. It's applicable IFRS plus IASB conceptual framework. So the preparer of the financial statement, when he producing, he should be complying with all applicable IFRS and IAS. Accordingly, now that one accounting standard is IAS 8, which is talking about accounting policies, accounting changes in accounting estimates and errors. As a result, according to the standard, you are just not allowed to change your accounting policies here and there offhand. What are the situations where the changes in accounting policies could take place? One position is that when a new accounting standards, when a new IFRS recommends or requires such a change, when a new IFRS requires such a change, that this accounting policy must be changed, or the revised presentation, the revised method or revised presentation giving a reliable and more realistic result. In this situation only, any accounting policies could be normally changed. Therefore, the finance director, he is planning to change the accounting policy from valuing the properties based on revaluation model to cost model is not generally allowed on that basis. Secondly, when producing financial statement, the director probably thinking that changing to cost model it will give him a better more increased profits. Actually, this case may not be also true. Why? In cost model, the directors need to depreciate those properties. So the depreciation of these large properties may result to high amount of charges in the profit and loss account. Also, there could be sometime if these properties are falling values in the market, then following in line with the prudence, even under cost method, you have to do an impairment test. And if you are doing an impairment test, and that test will result into a loss. So this could bring a reduced profits. Conversely, if you still think that the revaluation model, there could be benefits. How? Early years or the previous years, during the time when the market prices are good, when you are doing a revaluation, you could have been generated revaluation surplus. According to IA 16, under the revaluation requirement, when you have done any revaluation in the past, and if you still have revaluation surplus, what you have to do is you have to offset any subsequent deficit. Then, because if we are thinking, if we are falling in this line, still your deficit may not be charged to profit and loss account. As a result, you would still be better off with that situation. Further, these directors must be, according to ACCA Code of Conduct and Ethics, they should be following certain ethical principles, which are competence, integrity, objectivity, professional due care, and professional competence. These features they should be following. Accordingly, specifically, the directors must be maintaining the integrity and the professional competence. In line with professional competence, these directors are supposed to know the accounting standard requirement, and they are not supposed to violate this. If they are violating this, that could result into unethical behavior of the director. That is the answer for the first part. I will also send you the answers for the second and third part in the subsequent video. Thank you very much.